Good afternoon. For those of you joining us for the first time, I'm Roy Weiler, Director of Trading Operations for Time Leverage Capital. For anyone who missed our previous webinars, please give us a call at 800-519-9085, and we can send the videos you missed. You can also browse by topic on the Option Ranger website under Demo Videos. If you're a guest but not yet part of the beta program, please schedule a brief discussion of your current trading knowledge so we can prepare a lesson plan based on your level, at your pace, and on your schedule. Now for an important disclosure, please be aware that trading futures and options involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Please be sure to read and understand all disclosures before investing. All of the examples we discussed today are for educational and illustrational purposes only. Our examples are not individualized trading advice. Each person must ultimately make decisions based on individual risk tolerance and financial objectives. If at any time during the webinar you have questions or trade ideas, type them in the chat box and we'll do our best to answer them. Our presenter today is Mr. Adrian Mueller. He's the lead developer of the Option Ranger software and serves as chief strategist of the Dow Jones Megatrends, an all markets newsletter. Mr. Mueller is the founder and principal of the independent introducing brokerage Time Leverage Capital, and a former stock option principal. The program in which you are participating was developed over many years to train professional brokers and to provide user-friendly educational programs for individual investors. Without further delay, welcome to our Beta Group Spread Strategies Follow-Up, the Effects of Volatility and Directional Outlooks on Combination Positions webinar. Mr. Mueller?
Thank you, Roy, and everybody welcome aboard. We're going to go ahead and follow up on some strategies, and just as a quick reminder, there are multiple calculators depending on your level of experience on which we go ahead and provide the introductory information. Be sure that you are working with the one that is appropriate to your level of expertise. If you want some additional information on the software, be sure to go to our frequently asked questions/guide section. There you will find the features and benefits of the software along with some of the most commonly heard questions that we have received, contact information, and some friendly links to sites where you can get further information and definitions. Like all trades, today we're going to be reviewing some of the bear put and bull call spreads that we have reviewed earlier, and going to our strategy gallery. Both of those trading styles and strategies that we have discussed previously are listed in our strategy gallery, and both the bull call spread and the bear put spread, as you can see, they are mirror images of each other in the opposite, are both directional trades. The bull call spread is bullish, the bear put spread is bearish, and both of them have in common an expectation of diminishing volatility. And let's go ahead and see a couple of the trades that we have reviewed. Again, if you want to see a definition of how to input such trades and other types of information about trading, option classes, and so on, please be sure to go to our extensive demo video gallery, which provides input on how to enter trades, how to select trades, and the various features involving the risk and rewards of different types of strategies. Now let's go straight to our future spread follow-up, and again, this is for illustration purposes only. In fact, as you will see on our spread calculator here, many of the trades that were done are mutually exclusive of each other and have opposite directional outlooks. The feature they have in common is the outlook of diminishing volatility. And as you will notice, for example, in the case, and we will do an example first, on the S&P market, we did both an example of buying the S&P 500 index call spread from 1820 to 1920, which is a speculation on a 100-point rally, and this is a bull call trade. And in the very same market, in order to feature how this trade would look in the opposite direction with a bearish direction and falling volatility, we have an 1830-1730 put spread. So clearly a person with a bullish outlook and expectation of diminishing volatility might do the call spread, whereas a person with the opposite point of view would do the put spread. Let's see how these particular trades that were that were input on the dates listed would be doing today. So let's begin with a bull call spread that we entered previously. This bull call spread was entered on the 18th of February. And as you know, we input the contract values, the nature of the trade, the number of output rows, all costs, and came up with a profit and reward box. In this particular trade, we paid 63 points at $250 a point for the long call and collecting 17 for the short call. In this particular scenario, as you can see, at that particular point, there was a 44-point premium debit, and we factored in the cost, so we come up with a break-even of premium at 46.44. By way of illustration, because the volatility in this market has been undecided, but the direction has been up, this particular trade, in this particular scenario, based on the upside directional correctness of this particular forecast, would have picked up approximately 13 points minus costs since inception. And we know that the math on this particular trade, it's a tick value of 250. So you would do the math, and you can have a calculator handy, or there's probably one of on your computer. You would have 13 times 250, or whoever did this would have a gain of 3250 minus their commissions and fees, which here were listed at 110. Now this is again because the outlook of this trade was a bullish trade. The outlook was bullish. The expectation was for diminishing volatility, and although we had fairly active markets, as we indicated previously, an upside move in the stock market sometimes will not result in rising volatility. It appears that sometimes the volatility only goes up significantly when fear and panic strike the market and the options. Now, let's say, so as we can see now, this was a directional trade, and assuming these entries on that date and these fills, that would be the scenario because the trade was indeed bullish. On the opposite side of the same trade again, where we modeled a bearish trade with diminishing volatility, again, we actually started at the money near that strike price. The trade was a couple of days later because we were doing demos a couple of days later on the put spread. So this was in the course of doing the bear put spread webinar. And again, as you can see, on this particular transaction, there was a 57-point premium paid, and you see it's all translated into dollars and cents. There was a 28 premium collected, which was a net outlay of $7,250. We factored in the fees. So the total risk on this trade was $73.60. We have the high break-even points, and the premium break-even is 29.44. That's what was paid for the trade. If you look at the environment today in the S&P, again, this trade was directionally wrong. So if we would say that instead of that on this particular trade, there would be a loss of 25 points when you look at the current values, approximately. In terms of the values, the 1830 put is down at 42, the 1730 put is down at 20 approximately. So this bearish trade, because it was incorrect as to direction on the S&P, would be a loser of 25 points plus commissions and fees. So again, we use the same tick value, it's 250. So we're looking at that position being down pretty significantly. At just a moment, we are at the position is currently at 60 points. So let's say at 60 points times 250. Just a moment. We would still be incurring a loss on this trade because the long option, which has lost money, does not make up for its losses on the short option that was sold. So again, the directional lack of correctness on this trade would make it a loser. And this reiterates the point that buying a call spread or buying a put spread, as much as it is about direction, it is about volatility. And in this case, on undecided volatility, direction determines the day. we have, interestingly enough, an additional example that's very much along the same lines. We did examples, for example, on the gold market. And again, those were done on the different dates. Let's go ahead. This was on August gold. And again, it was labeled as a no margin trade. This was done on the 18th when we did a bull call seminar on February 18th of 2014. We demonstrated a bull call trade, purchasing the 1320 call at 58 and selling the 1420 at 22. Again, this is a bullish trade with the volatility outlook that is suitable. Again, we'll go to the strategy gallery for a put and a call spread. So again, with undecided volatility, the determining factor on that particular trade was direction. So now again, we look at the bull call spread demonstrated on the 18th, and we're going to see the opposites that was demonstrated on the 20th. In this particular case, as you can see, person has a bullish outlook, spends 37.1 points in premium. And we look at the current values on that position, and we are closer to 40. So in this particular case, the volatility didn't really help the trade, but the market has moved significantly. The 1820 call, as you can see here, is in the money, almost, pardon me, just a moment. The 1320 call that we discussed is in the money on the month of August by 19 points. So it's still gradually trying to work its way up, but based on time erosion alone, it would have to exceed some of these numbers pretty significantly in order to become profitable. So we need this market to keep going. The direction hasn't quite been there, so the call side of the trade is not yet working because the directional expectation did not work out. Although the volatility has indeed been diminishing somewhat, which is why the trade, if you update it in real time, has a different profit, has a lower loss scenario due to the diminishing volatility. And finally, if we look at the gold put spread, which is again the counterparty to the trade, in this case it's a $100 spread for a drop from 1320 to 1220. And again, in this particular scenario, let me just go ahead and click on the trade. Now we're looking at a put spread, bearish direction, diminishing volatility. The premium outlay for that position was 34.1 points, and since that spread is currently at 28, that trade would also be in losses. Number one, because the volatility, although it has diminished, the market has not proceeded to the downside, and in fact the spread at this moment is out of the money. The long call is intrinsically out of the money, and if the market stays above 1320, that long call will expire worthless along with the short put. So this is a time when if the volatility continues to fall, but the direction in either particular scenario doesn't go, whether it's the upside scenario for the bullish person, whether it's the upside scenario for the bullish person, or whether it's the downside scenario for the bearish person. In both cases, some direction would have to take place, or either one of these parties would have to look at salvaging premium if the volatility outlook and the direction don't change accordingly. As you track these trades, and as I provide some of the values to update, I would like to remind you that it's extremely important that you arrange to have actual values and premiums in real time to fully monitor these strategies and to see the values change in both premium as the underlying prices move. As you have seen before and have heard before, simulations have many limitations. In this particular case, we want to make sure that you input these trades here, but also have the opportunity to track those values as they go. And the easiest and the most user-friendly way to do it is to be sure that you are signed up for a platform and that you are inputting the trades that you have here on that platform and tracking the premium values as they move along. It is the best way to experience at a gut level, at a real level, how prices are affected. Let's not go ahead and go back to these examples, and since we have a couple of minutes, unless there are any questions, I want to go ahead and provide one other volatility example. And in this particular case, we were talking about doing doing strangles or straddles in the market. So for instance, on the 25th, and we've had some excitement in the bond market, we simulated a trade again, which in this particular case was a long strangle in the bond market. For people who don't recall what that is, when that is used, again, it's when the volatility outlook is undecided. We don't know which way the market's going to go, but we think that it's going to go big in either direction. And when you have that scenario, of course, you have the graphic here as well as the demo videos and the frequently asked questions where the trade can be explained. In this particular scenario, this trade is looking for a significant move, pardon me, in either direction by purchasing an at-the-money call and at-the-money put. Although the market has moved somewhat, we are still relatively close to the 132 strike price at which the strangle was done. And if the market does not make a significant breakout in either direction, an offset consideration should be done on this trade, or perhaps some adjustment into additional premium collection. Do we have any questions?
No, not at this time.
That's outstanding. We are going to follow up tomorrow with a very important piece of our program, which is the granting a call program, something that is both for covering a current instrument or for premium income on spec. It is one of the major legs of trading, and it's particularly in the case of follow-up to Module 1, which is buying a call. It's going to show us the counterparty and how the opposing expectations of the two people in a trade result essentially in a bet, in a transaction between the buyer and the seller of the option, which are founded largely on totally opposing points of view about the market. As Mark Twain said, it's a difference of opinion that makes the horse race, and I think that by putting the transaction of buying a call versus granting a call side by side, we will have the motivation and the both parties and the drama, the excitement, and analyzing what they do, why they do it, and how their expectations will play out under different scenarios. For those of you that have missed any of our previous programs, again, we encourage you to go to our demo video section where many of the programs are listed. If you have any particular trades you want to submit, please do let us know, and we highly encourage you to set up for a platform, a real-time tracking and position entry platform, so that you can even better experience the lessons of this program. Thank you all for attending, and we'll be seeing you and hearing you tomorrow.
We have a request actually for updated prices on that bond spread, the straddle.
On which one?
The bond straddle.
Okay. Okay. It's actually a very good request. If you would be so kind as to go ahead and give me those prices, and I'll pull up the bond trade and see where it is. Again, in this particular trade, to review the composition of a long strangle. The composition of the trade is to buy a call at 1.5, to buy a put at 1.5. So there's a total of 3 basis points. Pardon?
No, I'm sorry.
Pardon?
No, go ahead.
So there was 1.5 basis points paid for the right, but not the obligation to get long at 32. There was an additional 1.5 premium paid to buy the right, but not the obligation to sell the bond position at 132. So in effect, the market has to break out pretty significantly, actually by 3.11 points intrinsically, in either direction to intrinsically overcome the cost, or there has to be a sufficient move and rise in volatility to increase the value of the option, the premium on the option, past 3.11. So can we get current quotes now? What is the 132 call and the 132 put, please?
The 132 call is about 1.75.
Okay, so the call is up a teeny tiny bit, and the put?
The put is at 1.25.
Okay, please bear in mind that these are not necessary prices where you would get filled. We're just looking at, I think we're looking at what are not yet settled prices in these markets. But nonetheless, if you add up 1.75 and 1.25, we are exactly at the 3 basis points, the $3,000 that was initially spent, so that this trade, if offset at settlement prices, if such exits are available, or at the last prices, would only be down the commissions and fees of 110. If somebody has an expectation of rising volatility and a breakout in either direction, there's not what I would consider a significant change in the trade unless there's a significant change in the outlook. Since there was some decent, strong volatility to the upside, one of the advantages of such a trade, and it requires timing and good timing, would be if somebody had felt, well, I thought the market was going to break out, it really ran out, possibly at one moment on the strong rally have legged out of one part of the trade, which is the 132 call, and then try to play out the 132 put for a drop. This is very different from treating this position as a spread. And actually, one of the advantages of a spread is that should you change your outlook, either directionally or in terms of volatility, you can offset the position in segments. So you do not have to offset the call and the put that you purchased at the same time. You are not required to offset them at the same time. You can come out of one leg and leave the other in to work, or you can adjust one side of the trade perhaps into some other kind of a spread to capture back some of the premium that you have paid. And this is where it's very important to continue monitoring the trade and to go into the strategy gallery to adjust your position in accordance with your outlook. Okay. Are there any other questions?
Didn't we have a soybeans trade on also?
Yes, we did have a soybean trade. It's a very good point. And they are here. And oddly enough, I think all of the examples, being mutually exclusive, are pretty surprising in nature. So let's look first at the soybean call. And soybeans have been very firm on a variety of factors. And at this time, and again, we didn't cherry pick trades. The bull's part looks good and the bear part looks bad, but we're trying to provide examples, not recommendations. So if you look at the initial way that we input the soybean trade, just take a moment, let me give you the values. We bought a 1320 call, and again, these were July positions. That call is very, very well in the money. July soybeans are trading settled at $13.95 and a quarter. So as you can see, we paid 56 points, we collected 20 for a net difference of 36, factored in the transaction costs. So the break even on that trade would be 38.2. If you had your platform in place, you could just pull up those quotes right now and compare them, but obviously we'll be more than happy to do it for you at this moment until you set up. So how much are the premiums currently on that call spread?
That spread on the settlement was worth 55 cents.
So we're talking about a spread in this particular scenario that went from 38.2, and again, this is a simulation, so we don't have, these are not actual fills or recommendations, but if we went from 38.2 to 55, then the math would be simple, assuming those executions, 55 minus 38.2.
We'd be up $840.
That is correct, and again, you'd have to factor in all costs and so on, which are factored into the initial price. So, and why did this position go up? Well, again, it was a bull call spread. A bull call spread is a directional trade. It's a bullish trade, and because the market went up significantly, that trade is showing some gains at this point. Because we also sold a call, and the volatility has been going up, the trade as a whole, as a spread, is underperforming somewhat, because although we were correct in forecasting a bullish direction, instead of having volatility be undecided or maybe having it simmer down, volatility has picked up. So that the out-of-the-money call on rising volatility performed well against the 1320 call, and to some extent mitigated the advantages of being long at 1320 at short and 1420, because the volatility outlook was not accurate, although the directional outlook was. Again, obviously, when you're trading this, you'd be very happy to have such a trade, but for purposes of analysis, it's important to understand why isn't it up more on such a big move. And it's not up more on such a big move because the volatility went up on some explosive movement. And let's have a look again. And again, for purposes of objectivity, we demoed the call spread when we did a bull call spread demonstration, and we demoed the flip side of the call spread when we did a bear put spread demonstration 2 days later on February 20th. So let's have a look at that. Now again, in this particular scenario, we were pretty much wrong as can be. If this is what we had done, and again it's just a demonstration, the direction on a put bear spread 1 by 1 is bearish. This market went up instead of falling volatility or undecided volatility, that you had fairly strongly rising volatility. And let's look at what happened with this position. The spread was done at 49, which was paid for the long put at 1320.15, that was collected for the short put at 1220 for a net debit including costs and fees of 1810, which translates into 36.2 cents in premium. So this trade for break even on premium, and we're not going to get to intrinsic value, was at 36.2. Where are those values now?
The spread settled at 19.5 cents.
Okay, so we're talking at 19.5. So if I may take the liberty of doing a little bit of rounding up, because this is all a simulation anyway, we're talking about a loss in this particular scenario of 17 cents. Okay, approximately. So we're talking, just a moment. So in this particular case, that trade would be down 850. Again, the reason it's not down more is because with dropping volatility, the out-of-the-money option has lost value, but still not spectacularly as the market moves away. And in this case, this is a trade that was, both in terms of direction and volatility, would have been a wrong outlook. When somebody has a really wrong outlook like this, they have to immediately say, do I still think that this is the scenario that I believe in? Do I salvage on this position and cut my losses to 850 versus an additional 1,000 if I'm mistaken about the trade? And this is where the old dictum of he who fights and runs away lives to fight another day may come in very handy, because from current prices, intrinsically, for this trade to become profitable, with a large movement in the underlying contract, would require a very large move. Intrinsically, you would have to be looking at some kind of a drop in this market, a significant drop in the market, and you certainly would want to get under somewhere in the 1290 range, 1285 range. Your actual futures break even is listed here as 1283.8, and with the futures close to 1395 basis July, that's a bit of a move. So one would have to think quickly if they have such an outlook of a big drop, or look either for an exit strategy or some sort of an adjustment. Somebody's still bearish on this position. One of the things they can contemplate is salvaging premium on the long option, and perhaps rolling that position closer in if they're still bearish, and in fact adding another bear spread, but offsetting one of the positions instead of adding a bear spread, in order to reduce your costs. So instead of having 2 fees for rolling up for having a bear spread, you just have 1 fee because one of the positions you are doing to adjust is an offset. So these are some of the various ways to look at this position. And again, if this certainly looking at this, I would be very mindful, even with the time frame, that this position would need a significant correction to become profitable. Likewise, on the call, if you want to follow up on the call position, let's take a minute to go back to the upside, because the 1420 strike is not so extraordinarily far away. If one still has a bullish outlook and thinks the volatility will go up or go down or go sideways, that's where the considerations begin on whether to take the gain at 55 versus 38.2, whether to just hold on depending on volatility and direction, or whether to follow up with some kind of an adjustment strategy that would be consistent with your shifting outlook on volatility and direction. Again, all of these trades, as you would expect, were mutually exclusive of each other. So based on direction, since for those markets that moved, direction ruled the day. For the markets that didn't move, the trade stayed fairly neutral, as you saw in the case of the bonds. And in fact, that was a neutral trade directionally, except as to volatility. Any other questions?
Actually, we have a request on corn. I believe that there could be problems with corn this summer, possibly in planting or a drought over the summer. Would it be better to position in July or December, and how does volatility affect that?
Okay. Well, the first thing in terms of looking at the corn, and you know, is to be mindful that there is some sort of a differential. So presently, the December month is trading, the deferred month is trading lower in terms of its daily activity versus the March, but there's not much of a carrying charge or premium at all. In fact, there is none. The May contract, if you will look at it, settled out at 4.82. Let me just bring my quote screen here so that we can have a better notion of what we're discussing. As you look here, we see that the December contract is at 483.25. And the May contract is 40.82. So there's very little carrying charge between the May and the December. On the other hand, there's a bit of a carrying charge between the May and the July, and then gets taken out later on in the year, presumably in anticipation of production and some sort of a harvest. The weather crisis, if you are looking at a drought or a weather crisis, the commonplace months to trade would be July or September, depending on the liquidity, the volume, and your outlook. If you're using options, you want to get, if you're writing options, you want to get the greatest possible amount of time erosion, which would be to write something shorter term, perhaps either into May or a serial month into April, which trades off the May. In the case of going longer term, where you are risking a weather crisis, I would say that you should go as wide as possible, and my preference in options would likely be July, with perhaps writing some options in May on the volatility skew on a calendar spread, and we do have calendar spreads that we can model out. The long-term trade, you would have to be very mindful, because in a very volatile market, you could have the market run up on a weather crisis, as they often will, and then tank on harvest pressure, which to some extent, as you can see, is already factored into these prices. And I'd say a fair amount of the trading and speculation here, in addition to options, which is what we're demonstrating today in the instrument, will be spreads between different months. So somebody might say, well, if we really have a shortage and a problem and people start worrying a great deal, then the near month will outperform the deferred month on fear, and you buy the July and you sell the December on the futures as a future spread. And you have to also review the various planting and seasonal elements on that trade. Now, having said that, let's go ahead and see if we can, for a minute, using settlement prices, reset the calculator, and go ahead and look at a trade. Can you, whoever's asking this question, can I get some scenarios on where you think the market could run, let's say, by the July expiration? I'd love to get some feedback. If not, we'll make up a number, or we can use a number going on a chart. Let's start with the corn market.
He's saying 550. He thinks he can make 550 by the July expiration.
550 by July is the market settled at 486. I don't think that that is at all unreasonable based on the expiration. And then what we'll have to do, and this is what you'll have when you have a real platform, is we start comparing trades. So let's say the first thing we look at, and the volatility has picked up some in the corn, and this is a 70-cent move, which is not, believe it or not, that huge in the corn. So let's have a look at some call spreads first that go to the 550 price. And what I do here, just so I'm not, when we select, let's go ahead and put in some of the basic numbers here, and let's go ahead and sell the 550 strike, where we think the market is going to simmer down. Okay.
It's settled at 9 cents.
Okay, so we got the strike price of 550 at 9 cents, and as you see, the help boxes come out, so that we can input the trade. So here we input 9 cents, our strike price of 550. As you can see here, there's a decimal after the 5. So we do the same thing when we input there's no decimal input, as you see, the description here. We've input the premium as 9 cents, so that's what we sell. We'll see how many of them we do, just a moment. So let's go ahead and start with selling 1, because that's our objective. And let's buy 1. The market's at 486 on the settlement. So let's go ahead and buy a call at 490. The next strike up.
25.5.
Okay. Okay, so that's more money, but it's right there. It's got time. We're heading into a volatile season, so it's 25.5 minus 9. We're looking at a 5,000 bushel contract, and let's go ahead and do our calculation on the trade. Okay. Okay. We've got a spread of 60 cents here. Bought a call, sold a call. Those are the prices. These are the dollar amounts. So when you buy a call with that strike price, the premium is 25.5. That's $12.75 in dollars and cents. If you think it's not going past 550, you might as well collect $450. Take that risk off the table. You've got the cost factor worked in, so the entire trade on these parameters would be $8.95. Okay. The low break even on the futures, because you're paying premium, you still need the market intrinsically to get above 507.90 if you sit around till expiration and you don't offset. The premium break-even point, here would be 17.9, and this is a non-margin trade. So the maximum loss, if corn does not go up, but it just tanks through the floor and dies, is $8.95. By the way, it's really silly to buy an option for $8.95 and watch it go to zero between now and expiration. So if you have to have risk parameters and ideas on what you're going to do if the market doesn't go, and monitor it closely. The maximum profit potential, because it's a spread, is $2,105, and you max out that number when you exceed your strike price that you sold at $550, and actually you have your futures break even here as well. Now, this is a spread, and again, it doesn't look for a huge move, but let's say, for argument's sake, somebody says, you know what, I think the market's going to run, but I don't think it's going to get much past 550. Let me see if I can make this trade cheaper. I'm not recommending this. I'm just showing you a feature on how to examine the trade. So now we've already saved the trade under here. The first one we did is already saved, so we can look at it later. So we're not getting rid of it. We're just going to calculate again on a 1/2 ratio. This becomes a margin trade now. There's a naked option in there. All the prices stay the same. Now look what happened. It's only $375 premium outlay, including fees. The entire net outlay now is $480 instead of, let's look at the previous one, $895. So it's $480 instead of $895. On the $895, the profit is limited to $2,105 on the spread. On the new example, it's $25.20, so it's a higher profit. It's a lower input, but see it in red. The risk begins above $550, at 1250 per tick, and when you look at it on the spreadsheet, you've got a nice little sweet spot here above your break even intrinsically at 499 and 3/4. So now your break even at expiration on the futures is 499.6 versus 507.9. So it's 507.9 versus 499.6. And your break-even point on premium, when you track the premium, you just need to collect more than 9.6 cents on the 1/2, whereas you need to collect more than 17.9 cents on the 1/1. So the trade-off here is that if you don't feel strongly, if you feel there's a huge upside potential in this market, you need to definitely be mindful of it. And let me go to the margin example, if I may. No, excuse me, just a moment. Let me go to the just one moment. There we go, to the margin example, if I may. And as you can see here, your real danger starts above 6. So if you feel like, even if your target is 550, when you do a ratio, you don't really start losing because the deep in the money spread continues to outperform the naked option for a while. So in fact, if the market breaks out intrinsically above 550, even to 590, there's some profit to be had there at 580, 570, 560, and we have the math tick by tick to do it here. So if somebody felt like there's really, you want to lay out less, you don't mind a little margin risk above $6 or thereabouts, then the trade can be done as a 1/2. This can be changed in a variety of ways. I can just show you very quickly. We can just change the calculation. Again, this leaves just 1 is naked because you long 2, you sold 3. And without much delay, you get all the numbers. Your break even on premium here is 13.75. You see where you're, just a moment. And as you can see here, I'd have to expand the rows. You have a real nice sweet spot on that trade around 550. And actually, what you can do is adjust these trades so that your sweet spot at expiration, and you want as big a range as possible around your sweet spot before you start incurring losses, as well as monitoring your trade. So the reason this is an option ranger is because although your objective in this particular case would be for the market to be around 550, 560, whatever, 560 is still a good range, 580 is still a good range, and so on. And you have to be very mindful of a big rally because you do have one naked option left. So if you wanted to see, well, what's my risk on a on a bigger rally, you increase the number of rows. You see at what point that naked option really starts doing some damage, and as you can see, on a really explosive move above to let's say above 642 thereabouts, once you start getting to 650, 670, and so on, the naked option would outperform. But this is a pretty sizable move for an investor to sit on his hands and not make some sort of an adjustment. I think anybody who'd be in a trade that they enter July corn when the market's at 486 1/4, they put on a spread and the market gets to $6 and they haven't looked at it and they haven't made an adjustment or thought about what to do next. People like that really shouldn't. They can be simulating, but they certainly shouldn't be in the market. You do have to monitor what you do. And finally, just along the lines of this example, I wanted to do one more, in which, let me go back to the 1/2 example, in which somebody said, well, I don't mind a 1/2, but I really think the market might move more. So let's say in that case, let's say they want to change their strike price to 560. Give themselves a little more room. What's the premium on that, please? So let's say if we go to 560, I'll wait a moment while we get that premium.
For the 560, hold on.
Yeah.
It's settled at 7.5.
Okay, so we're going to call it 7.5. Excuse me. 7.5. Again, we immediately do the calculate. We don't have to input everything else. And we get the particulars of the trade. Again, now it's only 525 laid out In this particular case, it's a margin trade. There's a naked option, the second one over here, and we have our low break-even point on premium, and we also have our break-even point on the futures. And then again, most importantly, a picture's worth 1,000 words. We're looking at a sweet spot here for that position. And as you can see, because you collected less money on the 560 and wrote them farther out, if that was a concern, you would have more room before you start hitting these red numbers. So let me just go right to the previous example, where instead of the 1 by 2, and you can compare them one after the other. So this is the 490, 550, 1 by 2. And we'll look at a sweet spot here that kind of ends around $6, if you will. I'm just ballparking it. By collecting less money on the 560 while selling a couple of them, as you can see, instead of where the sweet spot here ends around $6, 602. Again, these are just approximations to get an idea. At $6 or 602, the wider spread that's sold farther out of the money options for less premium does give you more breathing room before the second option starts to hit. So again, what you want to do is practice with different ranges and different strike prices and different premiums to come up with what is your sweet spot, both in volatility and expectation. And again, you can, once you come up with these numbers and these ranges, the easiest thing to do with your saved tabs is just adjust the position sizes, see which trade makes more sense. You can do, again, depending on your situation, you can do crazy things. You can look at a 2 by 5, looking at those strike prices. And again, if that's within your trading parameters and risk parameters, again, you've got a sweet spot again that you're seeing. And based on that and based on the levels where your profitability is and what your maximum risk, what your risk is on a drop, what your risk is on a rally, and where is your sweet spot in the middle. And again, one other thing that you can do here is you can do this as a covered futures, and we will get to that later. We can actually buy the instrument and collect premium against it, so you are making so that you're not spending premium, you are just collecting premium. And we're going to show those examples when we do covered calls and covered futures, which are not just popular. Covered futures are not just popular for usage in the futures market, but are one of the most commonplace and likely to be approved transactions in stocks and stock options. So knowing how to do covered calls is very important. Now, if you expect the move to 550 to be fast and with rising volatility, what we can do here is very simple. If you think that it's just going to be a weather crisis and the market's going to fly, a simple thing to do is to just buy a call. Let me just make sure that I have the selection. No, this is a call spread calculator, so I'm going to go back to I'm going to go to our master calculator, if I may. Better yet, I'll go to our basic, and we're just going to show buying a call in the call market. Again, what we're looking at here, and these were other examples that were provided for different markets. We're going to look at the corn market. We're just going to buy a call. This is looking for, as you can see here, you want the direction to go up. And if you think the volatility is going up, meaning that you think that the weather is going to happen and people are going to start panicking and worrying about all kinds of things, so in that event, the person can buy one contract. 550 is out of the money, so let's go ahead and try to do a $5 strike price, which is not too far away. The market's at 486 and a quarter, so it's slightly out of the money. And how much would that option be for July, please?
It settled at about 22 cents.
Okay, so it's a little bit more of an outlay. It's a little more of an outlay, but let's go ahead and do the math. As you can see, we got all the illustrations here. You can go to contract specs, and you can also look at further detail on buying a call before you jump in, so that you make sure that your time decay outlook, your profit and loss outlook are correct. And you can go to our demo video. So let's just have a look at buying a call. Now, this is for direction up, volatility up. Okay, as you can see, in this particular scenario, the outlook is 1,100 plus fees. The break-even on futures, and again, you shouldn't really wait till expiration. It's a volatility play when you buy calls. Intrinsically is at 522.70, and your premium break-even point is 22.7, including all your costs. And again, the reason many people will buy a call is because they have a predetermined and limited risk. If you don't offset, if you don't come out, if you sit on your hands till expiration and the market is down, that's the maximum loss. The profit potential is unlimited, which always people pay a premium. And again, unlike in the cost spreads we showed before, the upside is unlimited because all we did was pay premium, but we didn't collect premium. Now here, as you can see, for a very big upside move, the numbers get pretty strong. The bigger the upside, the stronger the number. But if the market does not go up with rising volatility, which is the key to a call option, then time erosion is going to be a minus for us. The volatility does not go up. That's going to be a minus for us. And then, as you can see here, a person could incur the maximum risk, or even on a rally, directionally correct but without rising volatility, could run out of time and still end up losing on a trade. So if one sits on their hands till expiration, the market creeps to $5 from 86.25, the direction was correct, but the volatility would be insufficient to make this trade a profit. So when you buy a call, you want it to run, you want it to run fast, and you want it to run soon. If that's not your expectation, then you have to find your way back to some of these other strategies which are not looking for as volatile or as powerful a move. And the key is to keep putting in trades, to keep comparing break-evens and profit points in these boxes until it becomes more and more second nature to you, until it becomes more and more easy to digest, and then you'll know how to make this sweet spot better for you. So let's say somebody says, well, you know, I think it's either going to fly or it's not going to fly. I'm going to take a shot that we're going to have horrible weather in a big market. And again, while we don't usually recommend this, let's say somebody has a dream. John Smith is has a dream in the middle of the night that there's going to be a huge drought. And he sees, he dreams of Henry Fonda and Grapes of Wrath going up and down the Dust Bowl trying to survive. And he says, I think corn is going to some crazy number, 650. I'm not saying this is going to happen. I'm just making up a scenario. So a person like that might say, you know what, I'm going to buy three out of the money options, which are kind of a long shot, but I think this market's going to get crazy on weather. And they turn around and they buy 3 550 calls for July, which are out of the money. I'm not sure with the situation that we've had if that would really be deep out of the money in this day and age. And then we're going to say the premium there, as I recall, was 9. Okay, so let's see what happens here. And again, this is looking for really rising volatility and a big move. Person's maximum risk, as you can see, because it's still buying call options, it's a limited risk trade, they're costing less, they're out of the money. Total of $14.55, including commissions, defaulted at 35. The risk is still limited. And again, I think if you and your broker or you, whoever you work with, incur this maximum loss and sitting on your hands, then you should recruit a third person and revive the Three Stooges. I might have to volunteer if I'm involved, because premium like this is the maximum loss. It is really absurd to make it the loss if you're watching and monitoring your risk. Nonetheless, that's the maximum textbook risk. Your profit is unlimited, and look at this, because you bought out of the money. It's a long shot. You're looking for a home run. Intrinsically, you need to be above 550, 970. So it's a long shot, but if you think that's going to happen and you think it's going to happen fast, your premium break-even point is 9.7. Rising volatility, quick move, the market could be nowhere near 550, 970, and this option could double in value or more. You have to monitor it. That's why volatility rising here is so essential. But then when you look down the grid, because you're really looking for a home run, that's your outlay, and let's say we get our wild scenario of $7 or more, and again, this is not a commonplace event, but it's an illustration, and it would take some weather or some other disruption, as you can see here, even at 620, which is, we've been there, it's not an outlandish number. the numbers really increase, and if you end up at $7, that's 80 cents more on a 3-lot. That's $2.40 times 50. You know, you're looking at your tick value. It's another 12,000 on top of the 9,000. So now all of a sudden you're talking about again, it's a huge move. It's not a common move. It's not a move that we've seen a lot or suggesting we've been in a lot. But when you look at this risk and you weigh it against the possibility, some people may say, I'll take a shot with a 3-lot. You know, make sure you get appropriate consideration on your fees. Maybe I'll take a shot with a 2-lot, see how that looks, how much I'm laying out. And again, in this particular case, the outlay would be $970, including fees. The maximum that could be lost would be that $970 without offset. And again, on a significant move, the risk to reward ratio is very good, as it would be whenever a long shot comes in. And although I wouldn't call this a wild long shot, it is an out-of-the-money option. And arguably, maybe it's a matter of opinion whether or not it's a deep out-of-the-money option, but I would definitely put it in the category of a long shot that needs to be monitored. So those are some different ways of trying to take advantage of being long into a weather market into this time frame. When you better define your outlook, where you think the market will hold, where you think it's going to go, we can further fine-tune this trade to be exactly in the range that we want. Do we have, is there, whoever asked the question, do they have a support level for this market?
They didn't say.
Okay. Well, I would love to hear it if it's available or if it can be input in our conversation. If not, hopefully we're going to get it later on during our setup of modules and lesson plans, and then we're going to fine-tune that trade and hopefully pick it up on Friday during Hot Market Fridays when we have a better idea of how the corn is behaving. It's an exciting market. We're heading into that time of year. Several markets have been a crossroads, whether you're looking at the grains, which have been very active, sugar that has been very active, crude oil, which is off over $2.40 on the April contract today, the S&P, which has burst above the 1870 level, and bonds, which have been rather volatile of late as people go back and forth between risk and between fears of geopolitical problems and inflation concerns, fighting each other for different directional outlooks. Any other questions?
No, that seems to wrap it up.
Okay, well, I want to thank everybody for attending. I especially appreciate your questions, and we are going to continue doing examples in the grains, and we'd like much more feedback on specifics so we can define our outlook and our ranges even more to address the questions that are posed. So thanks again for attending. Remember, we want you to be successful through knowledge. While knowledge is not necessarily a guarantee of success, I think ignorance is a pretty sure guarantee of failure. So we must do everything that we can to know as much as we can when we put money on the line in the markets, and that's the point of this program. Thanks for attending, and keep at it. We want to hear from you. Good afternoon.
Just a reminder, if you missed part of the, I noticed some people showed up late. If you did miss part of the webinar, you will receive an email tomorrow morning that will have the complete webinar in it. If you have any questions, give us a call at 800-519-9085. Thank you.